Hello everyone, this is Terry with Futures.io, and as always, I would like to thank you for joining us today. It's my pleasure to welcome back Vinny Nizian from GFF Brokers for today's webinar, Don't Let One Bad Trade Wipe Out Your Entire Account. Throughout the webinar, if you have questions, please feel free to type them into the questions box, and we'll do our best to answer them at the end of the event. This webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, subscribe to the channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it back to Vinny, and you'll get the pop-up to share your screen again.
All right, Terry, I guess everyone can see my screen now.
1 second. You should get the pop-up again to select it. All right, looking good. She is all yours.
All right. Hello, everybody. Thank you, Terry. Always a great help. And thank you, everyone, for joining us today for our presentation on risk management, also known as money management. While risk management may not be a super exciting topic to cover, but in my opinion, coming from the broker side, it is extremely important and arguably one of the most important parts of anyone's trading plan. This may be a very grim statistic to start this webinar with, but it's really worth stating that it's estimated that as many as 90% or more, yes, 90% of day traders lose money at some point. So having a strategy to manage losses when they do happen is very critical. Every trader needs to have a solid risk management plan built into their trading strategy. So this is what we're here to talk about here today on a very preliminary scale. If you have any questions, I'm happy to try to answer them at the end. We will have some time left over for some questions and answers. So let's get going. But before we get going, I also want to remind everyone that there's a substantial, I should say, risk of loss in futures trading, and to only trade with capital that you can afford to lose. And also, this presentation just is in regards to my opinions on these topics. You definitely want to basically do your own research as well, but again, these are my opinions on these subjects. Today's presentation is on risk management. And again, my name is Vinny Nizian. I've been a broker for 15 years now, or more than 15 years. Starting to feel a little bit old now. I have seen many successful traders, but I've also seen even more traders who did not come out ahead. The areas of risk management that I want to go over today are outlined here below. Number one, risk capital, also known as risk tolerance. Profit targets. We are going to look into setting daily targets and also targets for a specific trade. Loss limits, daily loss limits, and loss limits set on each specific trade. Overall trading preparedness. And last, performance evaluation. Evaluating your trading to make sure that you're keeping up with your goals and staying on track. Let's go to our real quick and discuss risk capital. This is very important. What is risk capital? In simple terms, risk capital is money that you can afford to lose. How do you calculate risk capital? This is different for everybody, but this is the money that will not affect your lifestyle should it be gone. So you do not invest money that is meant towards going for paying bills, paying your mortgage, day-to-day living expenses. Do not move your entire savings account into a futures account. You need to closely look at your finances and determine what amount of money do you want to save and what amount of money you're comfortable risking in the market. Knowing that you might make money on your investments, but also you have to consider that you might lose money on your investments. How do you decide how much money you want to put into your futures trading, Once you have evaluated your finances and made an honest assessment, then you need to decide how much of that risk capital you plan to allocate to futures trading. Some people choose to allocate all of their risk capital into futures trading, while others choose to diversify between multiple investment types. Even within futures trading, some people choose to have their money traded in an automatic trading program. Some choose to do their own trading in a self-directed account. And some choose to have a self-directed account and also an auto program to help diversify their approach. This is a very personal choice, and it should be made by you and you only, in my opinion. Assuming you have the risk capital and you decide to trade futures, and then let's move ahead. In futures trading, you should expect to have some losing trades, but hopefully have enough winning trades to come ahead. Now, in regards to risk capital, I want to quickly add that whenever you stretch to fund your accounts, in my opinion, it adds that extra element of fear. If you're comfortable investing only, for example, $5,000 into a futures account, but for any reasons you feel that you have to stretch because of margins, or you have to stretch because your broker's minimums are higher, I already feel you're kind of trading halfway defeated, the psychology side of it, because you're trading with the sense of fear that the money you have in your account is not your true risk capital. Let's move on to our next subject in regards to profit targets. What to do when your trade starts making money. When we talk about profit targets and profit goals, you need to think about this on a per trade basis and also on a day-to-day basis. The psychology here is that when you need to set a goal ahead of time, when you're thinking more clearly, when you're not in the heat of the moment, you make a solid plan for the day and a plan for your trades before you start each trade. For example, say you start the day off and you get into a trade and you're going for a 2-point profit target on the mini S&P. And it's simple enough to stick with your trade, but also in the excitement of the market, your trade may hit its limit price, but emotions kick in, you cancel your limit, you cancel your exit target, and you decide to basically go for even more profits on this trade. I've had countless clients who have set a profit target on a winning trade, and then for lack of better words, get greedy, decide to cancel that, and then turn around and maybe exit the trade instead of a 2-point profit at a half-point profit or even a loss. If you're not already doing so, you may want to decide on a predetermined basis what your plan is for that trade. And once you're in the trade, try to stick to your plan. You should have a profit target in your mind. Better yet, most electronic trading platforms, very simple, will allow you to place what's called a limit order. With a limit order, when the market passes through your profit price, your order gets filled. In addition to creating a profit target for each one of your trades, you also maybe want to consider a daily goal. If you decide to make a daily goal, then if for any reasons you achieve that daily goal, then maybe you could call it a day and take the W and maybe go on and study the trades and study what you did that day and see if you can learn and build from it. But before you walk away from your computer, as always, you want to make sure you don't have any working orders, and you want to make sure you can, as elementary as it sounds, to check the amount of buys versus the amount of sells to make sure that you're flat, and also do not leave any working orders again, I want to say, because the worst thing sometimes that could happen is you have a profitable day, forget to cancel a working order, the working order fills, and then you turn around and lose a little bit of money because of that, or lose some money because of that. While maybe having you not overtrade your account and stick to your plan may mean less commissions for your broker, but I'm sure whoever your broker is will be happy to have you for the long haul. All right, now let's talk about the reverse side of this, loss limits. Now, most electronic trading platforms will have a feature to let you place a stop order, also known as a stop loss, which means that the platform will close the position when the market goes below that amount that you have defined as your loss for that trade. Please be aware, though, that there are instances where your stop loss may not trigger in cases where the market is not liquid, either no buyers or sellers, or in case of electronic disruptions, stop losses can fail. And although stop losses can be considered a risk management or loss management strategy, their functions can never be 100% guaranteed. That said, orders are typically successful and are definitely an important part of risk management tool. Let's talk about some trading psychology here on the loss side. Sometimes you may have a winning trade, and sometimes you'll have a losing trade when trading futures. And when you have a losing trade, you need to be able to accept the fact to take your loss if it hits your certain loss limit for that day or loss limit for that trade, for example, and move on to the next trade. In my opinion, this is one of the hardest parts of trading futures. It is not a strategy issue, more of a psychological one. I've had one client one time tell me something that stuck with me a long time ago, where he told me whenever he trades, he tends to eat like a bird, but go like an elephant, meaning he tends to have small profits, but whenever he has a loss, he tends to give back like several days worth of profits. Do not let a small loss turn into a huge loss because you think the market will turn around. Stick to your plan. Let me give you an example. Say you start the day with a $300 loss limit in mind. So you're starting the day telling yourself that if I lose $300 today, then I'm done trading for the day. Say your first trade, you decide to buy the mini S&P, and you decide to put a 6-point stop loss under your entry. As the market tends to approach your stop loss, to say the trade doesn't go your way, the market's already about 5.5 points, almost at your 6-point stop. You decide to cancel your stop, drag it from 6 points to 9 points. Then it gets closer to 9 points. Again, you cancel, drag it down to 12 points. Your whole thing is you're optimistic the market may turn around and go back in your favor, but at the same time, what you're doing is you're kind of digging yourself into a deeper hole here. So basically, let's say that the trade now, instead of exiting at a 6-point loss, you exit at a 12-point loss. You ended up just giving away 2 days worth of loss limits on that one specific trade. So in my opinion, sometimes sticking to the plan may be great, taking that loss and moving on to the next trade. As we discussed, setting up a profit goals is important to set up daily loss limits as well, as we just discussed. When you're having a really bad day, maybe it's not your day. Maybe you just got to call it a day and move on and see what went wrong, study the charts, study the market, and see what you did and what you could have done different, and try to go off those mistakes and try to learn from those mistakes. Again, one of the most difficult, if not the most difficult part of being a day trader. Let's move on to a different topic real quickly, trading preparedness. While the risk management tools we just gone over are very, very basic, but they're also invaluable. I cannot emphasize enough the importance of trading preparedness as well. Why is this so important? There are certain basic things that a trader needs to be aware of. There is nothing worse than losing money because of a careless error or oversight. I actually have a whole presentation that I've done on this subject, but we're not going to go into too much detail today. We'll just touch base real quickly. If you have any questions about trading preparedness, my email will be up on the screen later on. You're more than welcome to contact me should you have any questions. In regards to trading preparedness, as elementary as it sounds, first and foremost, memorize your account number. For any reasons you need to call your broker, your order desk, knowing your account number by heart will get you serviced much faster when placing your trade. You also want to discuss with your order desk in regards to the proper way of placing trades or calling the order desk. What is their procedure? How are things going to go most smoothly if you do decide to call them? Avoid novice mistakes and don't overlook the importance of knowing the basics as well. Making a simple mistake such as trading the wrong month on a rollover week could be costly. Know the trading hours for the markets you trade, plan for the holidays, get to know the contract specifications for the markets you trade or intend to trade, such as point value, daily limit, tick value. Know the day trading and overnight margins, and what is your broker's policy towards those margins. You may want to discuss with them, say, hey, I'm looking to add the CL to my trading plan, and I want to basically discuss how are the margins, what time does the initial margin kick in, is it 15 minutes prior to the close, how are the after hour margins. Definitely should call your broker and discuss that and not have to learn on the fly. We also, in regards to trading preparedness, we have some pretty neat futures calendars on our website. These futures calendars will help you stay in touch with current government reports, holidays, delivery dates, tick values, so on and so forth. And I'll quickly want to touch a little bit more base in regards to these futures calendars because I think they're very useful when it comes to staying prepared or just staying on top of things. The first one we have is a 2019 futures calendar. Now this comes in 2 versions. It's a PDF and it's also a pocket calendar, which you can have physically on your desk. It's right under our homepage and under the resources tab. You could request one. And basically what the 2019 futures calendar is basically a booklet which has the entire year laid out. On the entire year laid out, you can see different important dates such as delivery dates, holidays, government reports, so on and so forth. There's also a section in the back which talks about or lists out contract specifications such as trading hours, contract specs, tick value, expiration dates, front months, bunch of information that I usually have the booklet around my desk as a little cheat sheet. That whenever a client asks me a question on this, for example, a market that I'm not 100% familiar on, I immediately grab my book, look it up, and I can look up the specs or the dates that are important to that. We also have our futures calendar, very similar, but what this is a basic interactive calendar where you can go in there and you can filter the reports based on what's relevant to you. So it asks you which markets you want reports on. You say you only click NG and CL, which is nat gas and crude oil. Then the reports you'll see generated are going to be the ones that are relevant to you. You don't have to go through all the various reports for the day. So again, if you want a printed copy of this futures calendar, we do have a bunch in our office. We'll definitely be more than happy to send you one via mail, but we also have the PDF version. Just email me at the end and I can send to you whichever way you want it delivered. Let's just move on quickly to our next topic. Trading preparedness. Be prepared for disaster. What is your emergency plan? Say your computer decides to take a dive, you lose internet connection. You may know how to place trades via your trading platform, but do you know basically what the proper procedure is in calling in orders into your order desk, your broker's order desk? Does your broker have a 24-hour order desk? If they're not reachable, what are you supposed to do? How do you contact them? How do you get out of a position? These are things that you should definitely discuss with your broker to see what are their options in case you do or find yourself in the trade after hours, for example, and your platform's not reacting, but you definitely want to exit that position. We've had in the past 12, 13 months some pretty violent moves after hours. So it's definitely good to stay on top of this if you do plan on trading at those hours or any time during the day, I should say. Let's move on and talk about statements. You should check your statements every day that your account is traded or you trade your account. Many traders only bother to reference their statement when they feel something is wrong with them. Make sure that you take the time to learn how to read your particular statement. Maybe you should have your broker go over with you and you can ask questions. When checking statements, it's important to pay attention to, for example, open positions, as you can see here, which positions held open. Also, margin requirement for that open position past the close, margin excess, account balance, commissions, fees, and basically your trades laid out. And why is one trade held open versus another? Is the highest price held open? In this case, it is the highest price. It may not be the first trade of the day. So knowing these intricacies of your statements kind of takes the guessing out. And I'm more than happy to discuss this with any of my clients, even if you're not a client and you're willing to go over this with me. I'll be happy to try to explain your statements to you. So basically knowing your statements, knowing how to read them, and also checking your monthly statements, very important part of operating a futures account. And while we're on the topic of fees, I want to quickly just talk about a promotion we're having where we're offering free CME market data for the year of 2019. This is for new and or returning clients. Basically what this is certain terms do apply, but GFF Brokers flips the bill for your market data, meaning we pay for it. So there is certain rules, but basically we have clients in which they open under this promotion and their market data is paid for by GFF Brokers for the entire year of 2019, which is kind of neat, helps a little bit. Let's move on real quickly back to our preparedness section. Getting back to the presentation, I want to round off the basic trading preparedness by encouraging everyone to keep up your education. Back to the resources. Many different things you can find, such as a futures glossary, quotes, if you need quotes for any given reason. There's also so much more great information on our website as well. You can find tutorials, ebooks on futures trading, and much more. Also under our resources tab, we have something called the Global Update. It's basically an educational newsletter that goes out once a month. You can sign up for that, receive that, read through it. One of the most important things about being an informed or a good futures trader is staying on top of relevant things. So let's move on to our next topic on trading preparedness. As I wrap up the presentation, I want to bring together with the final section, performance evaluation. We've talked about risk management tools, setting up profit goals, loss limits. We've talked about risk capital. We've discussed some basic ways to avoid simple mistakes by being an informed trader or prepared trader. Now let's talk about one of the most important parts is making sure you're sticking to your overall trading plan. There is making a plan, and then there's following your plan. Two very different things. Once you've beefed up your overall management component or risk management side of your trading plan, you need to make sure you're actually following through. This is where pulling performance evaluations comes in. The profit target and loss limits we discussed are helpful in keeping you on track on a day-to-day basis, but also you want to evaluate your trading activity on a wider time frame as well too. In futures trading, it is kind of hard to lose track of things, your balance. So you want to basically, when you take a step back and you look at your month-to-month reports and look at your balance month-to-month, then you can basically, you also do want to factor in other things such as making deposits, withdrawals. After you take all those into consideration, you will look at the overall direction your account is headed. Then you basically want to give yourself a grade, and if you're not happy with that grade, then you can move on and or move towards trying to rectify that. But in regards to your performance evaluation, it does come to a couple of key components that you want to pay attention to. These are some suggestions I have that you should pay attention. Overall profit and loss for obvious reasons, percentage of winning trades, percentage of losing trades, average size of a winning trade, average size of a losing trade. Let's take a look, for example. Let's say that your percentage of winning trades is 56%, which is a winning percentage. But your average winning trade is a lot smaller than your average losing trade. Then you basically, by looking at this and looking at a different perspective, not from a trade-by-trade basis, but from an overall performance view, you may look that that's not a winning formula, may go back to the drawing board. The most common way to get this type of information is by pulling data from your monthly account statements or possibly your trading platform as well. Setting up your system for pulling reports and evaluating your trades may be complicated at first, but once you have fine-tuned your process, I think it's worth the time investment, and it gets easier and easier. Doing routine evaluations on your trading performance and making sure you're staying in line with your trading goals are crucial in maintaining proper risk management on your account. If you pull data and grade yourself again and you're not happy with your grade, you can always stop for a week or two. There will always be a market, and you can basically go back to the drawing board and see what it is you could have done differently or what you could do differently to help basically work towards the different market conditions you're trading against right now. I would like to thank you all for taking the time out of your busy schedules to attend this session. I hope you found some of the information useful. Next time you find yourself in a trade and you hear that little nagging voice behind you saying, hey, you set yourself for example, 4-point profit target and it's at 4 points and you close the trade and it ends up being the right decision, I'll be very happy. Again, I want to remind everyone that there's a risk of loss in trading futures and to only trade with risk capital as well. My name is Vinny Nizian. My email is right here on the screen. If you have any questions, I'll be happy to answer them in person. You can give me a call, you can email me, even if you have questions in regards to margin setups, your statements again, contract specifications, why did my statement hold this position open and not that position. If you even need help navigating the calendar, even if you're not a client of GFF Brokers, I'll be happy to try to help. And again, I want to thank everybody, and we do have some time left over, I guess, for some questions. So I would like to maybe give it back to Terry here.
Okay.
Thank you.
If you have any questions, please feel free to start typing them in, and I'll ask them to Vinny. Vinny, can you slide back, or can you go back to the slide with the free offer for the data?
Yes, sir.
There. All right, there we go. This is a great offer. If you are interested, please feel free to visit the link and sign up for it. It is also under the Elite Members tab. There's a link there to get to it as well. All right, you can go back to the your contact information. I am not seeing any questions at the moment. All right, I'll give them another minute or so. Can you go into a little bit about how to pick a futures trading strategy? How to select one?
Well, futures trading strategy. First of all, again, you want to look at your overall risk tolerance that you have. Every person's different. Some people, for example, losing $300 on the trade may not be as detrimental as losing, to other people. It all is always on the case-by-case basis. In my opinion, I would say maybe 1 or 2% of your account balance you should risk if you're day trading on a particular one contract trade. That's just, again, my opinion. And also, if you have those low margins that a lot of brokers offer, those are meant to basically help make your buying power even greater, but it kind of is a double-edged sword. So you definitely want to limit the amount of contracts you expose yourself. I would say, in my opinion, to 50% of initial. So, for example, I think the ES margins are a hair under $7,000 right now for the full. So one ES position for every $3,500 might be a wise, risk tolerance type of situation. This is in my opinion, but other traders may be more aggressive or maybe more on the opposite end of the spectrum. So I would say 1 to 2% of your account balance on a specific trade on a one contract basis.
Okay. Are minis worth it as opposed to the full contract?
You mean micros versus e-minis? Now, basically, everyone is very excited about the micro indexes coming out May 6th. I get asked about it all day. I'm excited about it. I think it's going to be a very good thing for the future, for futures traders and brokers alike. Micros versus minis. We don't know yet how the micros are going to trade. We don't know what the volume is going to be like. We don't know the volatility. But after everything settles down, I do, in my opinion, when I was looking at the micros and I was paying attention to their contract specifications, the cost of trading micros, the margins, I would say once you graduate towards, if you're finding yourself buying 5 micros, then maybe it's time for you to consider buying a mini versus a micro, in my opinion, because the amount of margin you'll pay will be more. Micros are intended for you, to trade with a lesser balance or as a stepping stone to the e-minis. For example, I was looking at one of the FCMs we work with. The margins on the micros are going to be about $150 a contract to day trade on average, and the mini margin is $500. So if you find yourself buying 5 micros, you're paying $750 in margin for half the buying power of something that buys you the $500 margin. So obviously, per your broker, comparing margin to margin and looking at liquidity, I'm guessing that number will be around 3 contracts when someone should graduate towards from minis to micros. But there's also another element involved with micros is you can buy 10 micros and it's the same buying power and tick size as a mini. And if the trade is going against you, instead of just jumping out the trade entirely, you can just give the trade a haircut. Get rid of 3, get rid of 7. Slowly basically add to the trade or take onto the trade. It brings this whole new element of managing your position to the futures markets. That element was brought when the minis were introduced, when it was versus the pit traded commodities, was kind of something where a lot of traders will tell me was one of the enticing factors of trading minis versus pit traded S&P.
Awesome, thank you. And that reminds me, I'm going to shoot you an email. I think I want to do a webinar with y'all on the micros, so we'll touch base about that. If 90% of retail traders lose or blow up an account, what method are the winning traders using? Which time frames?
Well, that's basically, I do see in my 15 plus years since 2013, I've seen time frames where traders have made money and where they've traded very short time frames, 15 minutes, 10-minute trades, scalping methods. And I've also seen some clients who have actually done a stacking method where as the market moves more in their favor, they stack more and more positions. That was very popular when the market was moving very wildly a few months ago. I noticed that activity a lot. I've seen this, and I've also seen swing trading. If you have the equity, sometimes, in my opinion, holding a position And we all, at the end of the day, we know that these markets swing, and as long as you stick to your loss target with the swing trade, then sometimes swing trading may be percentage-wise one of the higher chances you may have. With scalping, getting in and out of the market a lot, you're inviting yourself to a lot of errors or maybe missed trades here and there, because you're so much more activity, so much percentage of calling them wrong. But I've seen some people do it pretty effectively, all three methods. I hope that answered the question. All right, guys, I'm assuming you guys can still hear me.
Oop, yeah, sorry, I was muted.
No.
That's all the questions. Thank you for the webinar, the information, and for spending some time with us this evening, Vinny.
Thank you, Terry. Always a pleasure.
Absolutely.
All right.